This week at the zoo, both the Nasdaq and the S&P 500 moved higher, with the Nasdaq closing the week close to all-time highs after some of the nation's largest technology companies absolutely crushed earnings estimates. Hello and welcome back to the Wall Street Petting Zoo. I'm Christopher Smith.
And I'm Robert Coburn. Our first big story of the week is that the US dollar continued its breakdown this week, dropping well below its 10-year trend line as gold and silver continued to move higher. There are a couple different interpretations of this. The most popular interpretation is that the Federal Reserve has been printing a lot of money, and Congress is doing a lot of deficit spending, which is causing the market to expect inflation. The problem with that interpretation is that there's very little sign of inflation right now. In fact, the latest inflation numbers from the Dallas Fed show inflation this year is well below last year's levels. And the Fed isn't really printing much money right now either. 3 weeks ago, we reported that the Fed had started pulling a little liquidity out of the market as it wrapped up a couple of its short-term lending programs. That has leveled off as we predicted, but it hasn't ticked strongly back upward. The other interpretation of the dollar's current weakness has to do with the balance of trade. The U.S. has done a much worse job of controlling COVID than other countries, and as a result, our economic recovery has lagged behind the rest of the world. We've compensated by importing a lot more goods than we're exporting right now, which reduces demand for our currency and weakens the U.S. dollar. When you adjust for the trade balance, the U.S. dollar is still comfortably above its 10-year trend line, so this whole dollar breakdown story may turn out to be a temporary illusion caused by the U.S.'s failure to control the COVID-19 pandemic. We'll keep you updated on this story as it develops.
Yeah, and if the breakdown in the dollar does turn out to be a fake out, boy, a lot of people are going to get burned on gold and silver trades. We may see the dollar gain a little bit of strength this week because we saw kind of a nice green candle on Friday, a little bit of strengthening in the dollar. So we'll have to watch this week and see if we get a little dollar rally. Also relevant to the dollar inflation theory is pending stimulus from Congress. The latest on that, Congress is working on a phase 2 stimulus package, which at minimum looks like it will include another round of $1,200 stimulus checks and an extension of the moratorium on evictions and foreclosures. However, Democrats and Republicans are fighting over unemployment benefits, and apparently they are still not even close to a deal on the package. Meanwhile, several of the emergency measures from the Round 1 stimulus bill have already expired, including both the unemployment benefits and the eviction ban. It may be 2 more fucking weeks before Congress manages to cut a deal on this, and there could be a lot of economic damage in the meantime. Especially keep an eye on banks and the real estate market, because we're already seeing a wave of tenants being evicted from their homes. About half of U.S. states have their own eviction bans in place, but in some places, landlords are illegally violating those bans, locking tenants out of their homes despite the bans. And some tenants are organizing to protest in the streets. I saw there was a protest in Minneapolis just a couple days ago over evictions. So there's a possibility that this could all lead to financial crisis or even to further civil unrest if Congress doesn't get its act together and move fast enough on this next stimulus bill. So keep an eye on all of that.
And our next big story of the week is that the economic recovery has pretty much flatlined. The backward-looking economic numbers for May and June have been coming in really strong, with really big positive surprises this week on automotive orders, home ownership rates, home prices, and pending home sales for those months. But the data for July has been less good. Electricity usage, restaurant reservations, airplane passengers, and retail sales have all been flat or down in July. Consumer confidence this week came in at 92.6, missing the analyst consensus estimate of 94.5. Continuing jobless claims this week missed expectations by a wide margin and increased week on week for the first time in 8 weeks. The New York Fed's economic index fell this week for the first time in 3 months. The number of investment grade companies whose credit rating has been cut to junk status or is on the verge of being cut to junk has continued to climb. The good news is that coronavirus cases are falling. The bad news is that they're falling slowly. And meanwhile, we're starting to see some economic pain. The one bright spot in the economy is housing. Mortgage applications look like they're still climbing this month, albeit not quite as fast as they climbed in June.
Yeah, and our final big story of the week is, of course, those earnings reports. Some of the worst earnings results of the week came from big energy companies like Chevron and Exxon, which missed analyst estimates for their earnings and revenue. However, there were lots of really strong results from other sectors this week, including big positive surprises from automakers Ford and GM, which both still reported pretty sizable losses, pretty sizable reductions in revenue, but their picture was much better than the analysts had expected it to be. Similar story with the agricultural equipment maker Caterpillar, which makes tractors. And of course, we also got increased full year guidance from pharmaceutical giant Merck and from telecom company Nokia, both of which beat analyst estimates on their earnings, as well as increasing their full year guidance. So pretty good results from those companies. But some of the biggest positive surprises of the week came from some of the biggest US technology companies. Amazon beat earnings expectations by $8 billion, which is an insane number for analysts to be that far off on their expectations for Amazon. Apple not only crushed analyst estimates, but also grew both of its earnings and its revenue by double-digit percentages year over year in one of the worst single-quarter economic contractions the U.S. economy has ever seen. To experience that kind of growth in a recession, great job, Apple. Facebook and Google also blew out analyst expectations on Friday. Most of these tech stocks moved quite a bit higher, which helped push the Nasdaq 4% higher, despite some really bad economic data this week. Google did pull back a little bit on its result because even though it beat analyst expectations, it actually posted a slight revenue decline, its first revenue decline in a number of years. With that, let's talk stocks we watched this week. Robert, what were you watching this week?
So this week I was watching Dunkin' Donuts, and I noted last week that their stock didn't really move when they announced closing 450 stores back in June. Now, when they reported earnings Thursday morning, they announced plans to close 800 stores, which is 8% of their total U.S. restaurants, and their stock tanked. And some analysts are saying there is more good than bad in this earnings report, but the damage has been done, and it will probably see a few more bad days of trading, but I don't see a lot of people buying donuts during this pandemic either. So I wouldn't go to your trading app and buying Dunkin' Donuts at this time. I also called out CDW as I thought they were releasing their Q2 earnings report on Wednesday, but that appears to be this coming Wednesday on the 5th. I think CDW will beat expectations despite some analysts thinking they will miss. And then I was also watching video game stocks like Take-Two and Activision Blizzard both continue to go higher, with Activision Blizzard teasing a return to their all-time highest price and Take-Two continuously growing higher and higher. What stocks were you watching this week, Chris?
Well, last episode I mentioned that I was watching the S&P 500 banking ETF because I believe that it will make a bullish trendline cross whenever Congress announces a new stimulus bill. We haven't crossed that trend line yet. We're still hovering near it, and we'll be forced to a decision point within the next couple weeks. If Congress doesn't get another stimulus bill passed soon, then we could see carnage for mortgages and real estate, which would be bad for banks. So that's something to keep an eye on over the next couple weeks. I think that the outlook for banks is not going to be great until we get that next stimulus bill announced. But as soon as that stimulus bill gets announced, we could see, improving sentiment cause banks to make an upward cross on that trend line. So something to watch for. What are you watching this week, Robert?
This week, so as I said earlier, with CDW announcing earnings this week and not last week, I'll be watching CDW. I'll also be watching Bitcoin. Now, Bitcoin broke the 12,000 mark very briefly on Saturday night, but it spent most of the week above the 10K mark. This has caused other cryptocurrencies like Ethereum and Litecoin to also go up in price. I think we will probably see a pullback below 10K, probably a few more times if Bitcoin does see a run that it normally sees after a halvening event.
One of the big pieces of news that I saw for crypto wonks this week was that Ethereum has surpassed Bitcoin in its usage. So it looks like Ethereum may now be kind of the leading cryptocurrency. It may take Bitcoin's crown from it in that regard. I do think, though, that we could see some weakening of those crypto numbers this week if we do see a little bit of a rally on the dollar. So, watch out for that, folks. This week, I am long on Merck, which is a pharmaceutical company. August is traditionally the start of the strong season for biotech. And it may be an extra strong season this year because of optimism around the possibility of a COVID-19 vaccine. Although, honestly, I think that if we see a positive vaccine announcement, if one of these vaccines gets approved by the FDA, then we might see the other vaccine makers take a hit because they've sort of lost the race. So it's going to be an interesting year for pharma. I'm not really sure what to expect. We've had a big run up because of all the vaccine optimism. So maybe this strong season for pharmaceuticals won't be as strong just because prices are already so high. I've got the biotech ETF as a kind of generalized play on the biotech space, but I'm overweight on Merck because it's one of the few companies I'm watching that has both really positive sentiment right now and a pretty good valuation. Merck has a pretty good valuation compared to a lot of the other stocks out there in the market right now. It has 2 COVID-19 vaccine candidates and 1 oral antiviral candidate for treating COVID-19. It's pretty far behind in the vaccine race, so it's probably going to lose in the vaccine race, but it's got a shot in the antiviral race. Merck announced on Friday that its antiviral candidate goes into clinical trials in September. It's ahead of schedule on its antiviral candidate. So we could see some hype begin to build around this stock this week as investors get excited about that antiviral. And Merck also reported its financial results on Friday. It beat the Wall Street consensus for both its earnings and revenue, and its full year guidance also came in well above the Wall Street consensus. So I expect Merck to go on a bit of a run here. I think that we could see really good results from Merck. And I not only own some shares in Merck, but I've also purchased a couple call options on Merck for sort of this next month. So we'll see what happens. It's a fairly large bet for me. Usually I stick to pretty small bets, but I like Merck well enough that I've taken kind of an outsized position, at least in terms of what I usually do. So cross your fingers for me, Robert. All right, folks, if you heard anything useful on the podcast this week, please give us a like, share, or comment. We would love if you would comment on our YouTube video, if you would push it out to some of your Twitter and Facebook followers. That really helps us get the word out. We don't do any advertising for this podcast. So word of mouth is the only way that we circulate the podcast to a wider audience. So we really appreciate your support. And if you would like to financially support the podcast, you can also look underneath the YouTube video for our referral link to Webull. And if you open a Webull account, then we get a couple free stocks. That also helps support the podcast. That goes a long way toward helping make it worthwhile for us to keep doing this. We invest a lot of time and effort to bring you the latest market news and views. Folks, we will see you back at the zoo next week.
See ya.